Imagine two people. Both walk into a bank. Both borrow $1 million. 10 years later, one is wealthier than ever. The other is buried in debt. Same bank, same money, same loan. Completely different outcome. Why? Now here's something even stranger. Some of the richest people on earth spend most of their lives in debt. Not because they're struggling, not because they're broke, but because they choose to be. They borrow money, then borrow more, then borrow even more, and somehow every new loan makes them richer. Meanwhile, millions of people take loans and spend years trying to escape them. So here's the question nobody seems to ask. If borrowing money is such a powerful wealth-building tool, why doesn't everybody do it? Why do loans destroy some people and while helping others build fortunes? Most people think the answer is money. It's not. The answer is time. Because the rich aren't using loans to buy things, they're using loans to buy time. And once you understand that, you'll realize the loan was never the secret. The secret was what the loan allowed them to avoid doing, and that's where this story begins. Part 1. The $1 million mistake. Let's say you own a business worth $10 million. The business is growing. Profits are rising, everything looks great. Then one day you need $2 million. Most people think the solution is obvious. Sell part of the business, take the money, move on. Problem solved. But wealthy people often see a hidden cost. Imagine you sell 20% of the company. Today you get your $2 million. Sounds smart. But 10 years later, the company is worth $50 million. The 20% you sold, it's now worth $10 million. You solved a $2 million problem by giving up $10 million of future wealth. That's the mistake wealthy people try desperately to avoid. Because every time they sell a productive asset, they're not just selling today's value, they're selling tomorrow's value too. And tomorrow's value is often much bigger. This is why the rich think differently. Most people focus on cash. The wealthy focus on ownership, because ownership is what creates future wealth. Think about a farmer. If he needs money, he can sell fruit, or he can sell the tree. One solves the problem. The other destroys the machine producing the solution. The wealthy spend their entire lives protecting the tree, because they know something most people don't. The biggest fortunes in history were not built by constantly selling assets. They were built by holding them. For years, sometimes decades. And that's exactly where debt enters the picture. Not as a way to get rich, but as a way to avoid becoming poorer. Because when the wealthy borrow money, they're often protecting something far more valuable than the cash that they're receiving. They're protecting time. Part 2. Debt buys time. This is probably the most misunderstood idea in personal finance. Most people think loans are used to buy things. Cars, houses, vacations, electronics. The wealthy often use loans to buy something completely different. Time. Think about that for a second. Imagine you own shares in a company worth $20 million. You need $3 million. You have two choices. Option 1, sell part of your shares. Option 2, borrow against them. Most people immediately focus on the cost of the loan. The wealthy focus on the cost of selling. Because selling stops compounding. Borrowing doesn't. And compounding is where the real magic happens. Imagine planting a tree. The first few years don't look impressive, but eventually the tree becomes larger, stronger, more productive. Every year it produces more fruit than before. That's how great assets work. The longer you own them, the harder they work for you. Now imagine cutting off one branch every time you need money. The tree survives, but its future becomes smaller. That's exactly what happens when people constantly sell productive assets. This is why many wealthy people would rather pay interest than sell. The interest is predictable. The future growth they're protecting could be enormous. And here's the crazy part. Sometimes paying interest is actually cheaper than selling. If an asset grows by 12% a year, and the loan costs 4%, which one is really more expensive? The loan, or losing the future growth? Suddenly the entire situation looks different. The rich aren't asking, how much is this loan costing me? They're asking, how much is selling costing me? Completely different question, completely different outcome. But this creates another mystery. If wealthy people are borrowing millions of dollars, why are banks willing to lend it to them? Why would a bank happily give a billionaire millions while making ordinary people jump through endless hoops? The answer reveals how banks really think. And once you understand it, you'll realize that banks trust something far more than income. Part 3. What banks trust more than your job? Most people believe banks lend money based on income. At lower levels, that's true. But at the highest levels of wealth, banks care about something else entirely: assets. Let's compare two people. The first person earns $250,000 per year. The second person owns $50 million worth of stocks, businesses, and real estate. Who feels safer to lend money to? Most people immediately think, the person with the big salary. The bank often thinks differently because salaries can disappear, jobs can vanish, companies can fail, industries can change, but productive assets usually continue existing. A rental property still has value, a successful business still has value, a diversified stock portfolio still has value. Even if the owner never works another day, That's why wealthy people often receive loans at lower interest rates. Not because banks like rich people, because mathematically speaking, they're safer. The bank isn't lending against a paycheck. The bank is lending against ownership, and ownership creates something banks love: security. Imagine you own $50 million worth of assets, then ask for a $5 million loan. Even if things go wrong, the bank still has a huge safety cushion. This is called margin of safety, and banks are obsessed with it. But here's where things get really interesting. The wealthy know banks think this way. So instead of focusing only on earning money, they focus on owning things banks trust: businesses, stocks, real estate, cash-producing assets. Because once you own enough productive assets, something incredible happens. Money stops being your biggest advantage. Options become your biggest advantage, and that's where the real game begins. Part 4. The billionaire who refused to sell. Let's imagine a billionaire named David. David owns 30% of a company. Over the years, that company has become worth billions of dollars. One day, David wants $100 million. Most people think this is simple. Just sell some shares. Problem solved. But David sees 3 hidden costs. The first cost is obvious: taxes. If David sells a large block of shares, a significant portion could disappear to taxes. That's money gone forever. The second cost is much bigger: future growth. Let's say David sells shares worth $100 million today. What if those same shares become worth $500 million 10 years later? Suddenly the real cost wasn't $100 million. The real cost was $400 million of lost future growth. But there's an even bigger cost, a cost most people never think about: control. You see, when founders sell shares, they don't just lose ownership, they lose influence, voting power, decision-making authority, control over the company they spent years building. And control is incredibly valuable. In fact, many wealthy people would rather borrow money for years than give up control for a single day. This is why you'll often see founders borrowing against their stock instead of selling it. They keep ownership, they keep control, they keep future growth, and they still get access to cash. Suddenly the loan starts looking very different. It's not just money anymore, it's protection. Protection from taxes, protection from lost growth, protection from losing control. And this isn't just theory. Some of the wealthiest people in the world have used versions of this strategy. Take Elon Musk, for example. For years, most of his wealth wasn't sitting in a bank account. It was tied up in Tesla stock. Now imagine you're worth billions on paper, but almost all of your wealth is locked inside shares of a company. You have 2 options. You can sell stock, or you can borrow against it. Selling creates taxes. Selling reduces ownership. Selling can send a negative signal to the market. Borrowing avoids all 3, and that's why many wealthy founders prefer borrowing against their shares instead of selling them. Because they're not trying to get rid of the asset. They're trying to keep it. This is one reason the ultra-wealthy often appear cash poor and asset-rich at the same time. Their wealth isn't sitting in cash. Their wealth is sitting inside productive assets. And the last thing they want to do is interrupt the growth of those assets. Again, notice the pattern. The goal isn't debt. The goal is ownership. Debt is simply the tool helping them maintain it. And this is one of the biggest secrets behind living on loans. The rich aren't borrowing because they need money. They're borrowing because selling is often more expensive. Think about that. Most people view loans as expensive. The wealthy often view selling as expensive. Completely different mindset. And once you understand this, another question appears. If wealthy people keep borrowing instead of selling, do they ever pay the loans back? Or do they just keep borrowing forever? The answer sounds almost unbelievable, but it explains why some wealthy families stay rich for generations. Part 5. The hidden tax game. Most people earn money, then pay taxes, then spend what's left. The wealthy often reverse the process. And this is where things get interesting. Let's use a simple example. Imagine you own stock worth $20 million. You need $2 million. Option 1, sell stock, get cash, pay taxes. Option 2, borrow against stock, get cash, no sale, no taxable event. This is one reason loans become so attractive to wealthy investors. Because loans are generally not considered income. They're borrowed money. And that means the cash arrives without triggering the same tax event as selling. Now, this doesn't mean loans are free. Far from it. Interest still exists. Risk still exists. But from the perspective of a wealthy investor, the comparison isn't loan versus no loan. The comparison is loan versus selling. And in many situations, the loan wins. Not because it's cheap, because selling is more expensive. But here's where the strategy becomes even more powerful. Let's say your assets continue growing. 5 years pass, 10 years pass. Your portfolio becomes larger, your business becomes more valuable, your real estate appreciates. Now the loan becomes smaller relative to the assets. The assets grew. The debt stayed roughly the same. This is why wealthy people become obsessed with one thing: staying invested. Because staying invested allows time to work. And time is the most powerful force in wealth creation. Which brings us to the biggest misunderstanding in this entire topic. Most people think the rich use loans to create wealth. That's not true. The rich use loans to protect wealth while creating even more of it, and that changes everything. Part 6. The formula most people never see. At this point, the strategy should start looking very different, because the real formula isn't debt equals wealth. That's what gets people into trouble. The actual formula looks more like this: assets plus time plus strategic debt. Let's break it down. First comes the asset. Without the asset, nothing works. The asset is the engine, the business, the stock portfolio, the real estate, the thing producing value. Then comes time. Time allows compounding to work. Time allows businesses to grow. Time allows investments to multiply. Time allows great assets to become extraordinary assets. And then comes debt. Not reckless debt. Strategic debt. Debt used to protect ownership, protect control, protect future growth, protect time. This is the part most people miss. The wealthy don't use debt to speed up consumption. They use debt to extend compounding. A great example comes from real estate. Imagine an investor owns an apartment building worth $10 million. Over time, the property increases in value. Instead of selling it to access cash, they borrow against the building. Then they use part of that money to buy another income-producing property. Now, one asset is helping them acquire another asset. This is how many real estate fortunes were built. Not by constantly selling assets, but by using existing assets to acquire more productive assets. This is one of the biggest differences between wealthy borrowers and average borrowers. Average borrowers often use debt to consume. Wealthy borrowers often use debt to acquire. And that's a completely different game. Which finally brings us back to the question from the beginning. Why do loans destroy some people while making others richer? Because debt amplifies whatever already exists. If you have weak assets, debt amplifies weakness. If you have strong assets, debt amplifies strength. The loan itself isn't magical. The asset is. The loan simply protects the asset long enough for time to do its work. And nobody understood this principle better than Warren Buffett. Part 7. Warren Buffett and the final secret. So, after everything we've discussed, let's go back to the question we asked at the very beginning. If living on loans is such a powerful strategy, why doesn't everybody do it? Now you know the answer. Because loans don't create wealth. Assets create wealth. Time multiplies wealth. And strategic debt protects both. That's the real formula. Assets, time, strategic debt. Remove any one of those three pieces, and the system starts to fall apart. And this is exactly why so many people misunderstand Warren Buffett. People look at Buffett and see investing. Stocks, billions of dollars, but very few people understand the engine hiding underneath. Insurance float. Here's the simple version. Imagine 1 million people buy insurance. Each person pays money today, but most claims won't be paid until much later. Some claims won't be paid for years. That creates a giant pool of money sitting in the middle. Most people would see that money and think, that's not ours. Buffett saw something different. He saw time. Time before the claims needed to be paid. Time that allowed him to invest that money. Time that allowed compounding to work. Time that allowed great businesses to grow. You see, Buffett didn't become rich because he had access to money. Millions of people have access to money. Buffett became rich because he understood what to do with time. He understood that if you can keep productive assets working long enough, the results become extraordinary. And that's the exact same lesson behind living on loans. The rich aren't obsessed with borrowing. They're obsessed with staying invested. They're obsessed with staying owners. They're obsessed with staying in the game. Because they know something most people don't. The biggest gains usually happen at the end, not at the beginning. Let's imagine two investors. The first investor constantly sells assets whenever he needs cash. The second investor protects his assets and stays invested for decades. For the first few years, their results might look similar. But eventually something changes. Compounding starts accelerating. The gap becomes wider, then wider again, until it looks like magic. But it isn't magic, it's time. The rich understand that every time they sell a great asset, they reset the clock. Every time they keep ownership, the clock keeps running. And that's why loans can become so powerful, not because debt is magical, but because debt can help preserve ownership, preserve control, preserve future growth, and most importantly, preserve time. That's the part almost nobody talks about. The art of living on loans is not really about debt. It's about protecting your best assets long enough for compounding to transform them. The loan is not the hero. The asset is. The loan is simply the shield protecting the asset, and that's why two people can borrow the exact same amount of money and end up with completely different outcomes. One uses debt to buy things. The other uses debt to buy time. One spends the future. The other protects it, and that difference changes everything. Speaking of Warren Buffett, there's one question that investors have been debating for decades. Did Buffett really beat the market through skill alone? Or did he have an advantage that almost nobody else had? Because once you understand insurance float, you start seeing Buffett's success very differently. And that's exactly what we uncover in this video right here. Did Warren Buffett cheat the market? Click on the screen and watch it next. Trust me, it will completely change how you think about Warren Buffett. And if you enjoyed this video and want more deep dives into wealth, investing, business, psychology, and how money really works, make sure to subscribe because every week we break down the hidden ideas that separate average financial thinking from extraordinary wealth. Thanks for watching, and I'll see you in the next video.